Exactly.
Yeah. Um, so Frankie, is Rosemary gonna join us?
She's at Hampton at Opel event, so I don't think she's available right now.
Okay. Okay. Well, I think then we could start. Thanks, David, to take time give us the update on the fund. First, I want to apologize because I have another meeting like at 3, so I have to leave like by 3 o'clock. But it's great. I think in terms of the investment so far, we are really impressed with the return and happy with the return, and like to hear a little bit more about what you guys are doing with the fund.
Yeah, absolutely. I think you know that we do these weekly, well, not weekly, periodic video reviews that we call VCFA briefs, and
Mhm.
we're about to record one updating VP7. So I thought what I would do is kind of give you guys a preview of that, and because I have the presentation that is a
Okay.
draft version that we're going to use. So I thought I'd go through that because that'll give you kind of an update on the fund, some of the new investments that we made, and just kind of the general status. Would that work for you?
Yeah,
Cool.
yeah.
And I think we can do this in a half hour so that you can make your next meeting. So
Well,
uh,
that's fine. I think Clarence and the rest of the team could stay on.
No,
Yeah.
let's see. We can get through it in half an hour. Fine.
okay.
Mhm.
And can you? I don't know who the host is, but can you enable me to share my screen?
Yeah, sure.
Thank you. Okay, great. Can you see this presentation?
Yep.
Okay, great. So this is something that we're going to be recording next week or so, and just giving everyone an update. But so you guys have a bit of a preview. But please stop me if you have any questions about anything.
Mhm.
So bear with me. We skipped a slide here. It's reacting very slowly for some reason.
So getting to the holiday mood.
Yeah. So the last report that we distributed was from Q1. We're getting the Q2 report out within the next probably week or so.
Mhm.
But I just wanted to show you what we were showing as of Q1, and where I think we're going to be kind of on a mark to market basis. So as of Q1, we called about 27% of capital. Fund was at about a 1.7x, and the commitments to the fund were about $87 million. We are pushing towards the final close of this fund right now. So as of now, we've got about $98 million in commitments. We're going to have another closing in the next week or so. That'll push us just over 100. I think where we are right now, I would expect the final fund size to be around $130-ish million or so, based on some of the commitments that we're expecting to receive. So the fund's going to be a bit smaller than we anticipated, but I think we're happy with the investments that are in the fund, which is really the most important part. And I think so because of that, we're going to probably generate more co-investment than is typical. So you'll kind of, if it's something you're interested, we'll probably continue to send out some co-investment notices.
Mhm.
So I'm going to get into some of the new investments we've made since Q1 and some of the performance of the existing investments. We expect the returns to be slightly up in Q2, Q3. Not really materially, so I think it's going to kind of be in that 1.7 to 1.8 range. But I think we're continuing to be very positive on the results. investments that we made this year, I think we talked a lot about daily pay. I think when we had the New Year's uh, uh, what was it, brandy tasting, a wonderful brandy tasting event you had. So I think we talked a bit about that company. That company's been doing very well, performing really ahead of plan. The one complication that I think it's run into is there's been a leadership transition. So the CEO decided to take a different job, and they elevated a very senior person within the organization. I think she's probably going to be the permanent CEO. But it always kind of makes us a little uncomfortable when there's a leadership transition. We've been talking to the board a lot. We're confident it's not indicative of any kind of problems within the company, more of a personal issue with the CEO. But the company has been, really tracking very well. We're issuing a report about that investment in the next week or so as well. 3 new investments that I'll touch on briefly. The most recent one was a company is in a fund called NGen with a company called Enzymatica. And second is with a fund called Rittenhouse Ventures, a company called Piano. Third is a company called Hayden with a fund called Autotech Ventures. So you'll see kind of the theme of what we try to do is we try to work with general partners who we've known for many years, because it really enables us to get a view into how they think and the companies that they know very well. So in all these cases, these are companies or general partners who we've known for many years. We got a few distributions in Q4 in 2024 so far, mainly from an investment we made in a fund called Felicitas. Small distribution. We're early in the life of the fund. While we're still fundraising, we are recycling all distributions. Once we're out of the fundraising period, again, it ends at the end of September. We're expecting hopefully to make some distributions back. I'll touch on the most recent investment, and that was with a fund called NGen. I've known the general partner at NGen for about 5-6 years, and they're a fund focused on health and wellness. Enzymatica is a company focused on gut health, enzymes to improve gut health. We actually just recorded a brief on this company, and I'll send you a link to that. We're going to be distributing that out next week, and that'll give you a deep dive into why we think this is an interesting company, why we think this is an interesting transaction. But the short story is, company has been growing very well, profitable company, and really at an inflection point. My partner Drew and Colin, who's one of our analysts, went down to visit with the CEO. And what we like are these companies that are at an inflection point. In this case, it's number one, a transition to them doing some more of their own marketing. So they've traditionally relied on marketing firms, which have worked, but they're kind of expensive. So they're transitioning to some of their own internal marketing, which is we think going to improve their margins. And then I think what you're seeing is the CEO is actually really positioning the company for sale. So I think this is probably going to be about a 2 to 3 year hold for us. We've modeled it to about a 2.5x return, but I think that's pretty conservative. So I think there's some good upside into this transaction. We're excited about this deal. We put $5 million into it. So I'll send you a link after this to a separate 7-minute video where you can really see some more about it. I think it's a pretty interesting transaction. Piano is another pretty interesting deal. So we've known the general partner at a fund called Rittenhouse Ventures. They're a small Philadelphia-based fund. We've known them for probably about 10 years. We've never done a transaction with them. We haven't really found the right opportunity, but this seemed like a really unique opportunity. they had pro rata rights with one of their portfolio companies, a company called Piano Software. Piano is a audience management software service company for websites. The thing they're most well known for is they do paywall software. So if you go to the Wall Street Journal, they might give you one article free, or they might give you 2 articles free, and then after that, you'll get a message that says something to the effect of, you need to pay for this additional, to keep reading this. And that's their software that's driving this. So you see Dow Jones is listed there as one of their customers. So they do that kind of software as well as some audience analytics software. Company has about $100 million in revenue, profitable company. They needed to put some cash on their balance sheet to refinance their debt. We had pro rata rights through Rittenhouse, and so we participated in a security that has 2.5x has a 2.5x preference on the company before anyone else gets their money back. And so it's a very safe security. Because we know that there was an offer from a private equity firm you might be familiar with, Vista Equity Partners, to buy out the company, which would have easily cleared our preference. So, this is a company that's a strong company. I don't think there's a huge amount of upside from where we are right now. So I think we're probably going to end up with about that type of return. So about a 2.5x type of return to the fund. But when we think we can get a good 2.5x return in a reasonable amount of time, we think those are great types of deals to do. So that's Piano.
Sorry to interrupt, David.
Yeah.
Just one quick question. So what's the relationship between you and Piano and Rittenhouse Ventures? So I noticed the seller says direct share from the company, but like you invest Piano through the Rittenhouse.
So yeah, so what we did is since Rittenhouse has the direct relationship with the company, what we did is we set up an SPV, and we actually control the SPV, and Rittenhouse is an advisor to the SPV. But by setting it up that way, we can transfer their investment rights provisions into our vehicle. So it's a vehicle that we control, Rittenhouse advises, and the vehicle that we control owns the shares directly in Piano.
I see. So all 3 new investments are all in forms of SPVs.
Not always. But a lot of times it makes the most sense for us to set up a special purpose vehicle. It's an LLC. It's a simple, just for ease of accounting and for transferability, and also to kind of limit some of the to enable us to limit any kind of liability just to that entity. Not that we think there is any liability, but
okay. But there's
do you have to share your income with Rittenhouse?
I'm sorry, can you say it again?
Do you have to share any of your future income with Rittenhouse?
They have a carry over 2x. So after 2x, they get a 10% carry.
Okay.
So it's a small share.
Okay.
And in return for that, they're representing us on the board, providing us with all the information, and providing valuations on a quarterly basis for us.
Okay.
So that's the only fee layer between us and other than VCFA alone, that's another fee layer. But like that's the only fee layer.
Yes, that's the only fee layer.
Hey, David.
Yes.
Hi. So is this similar to like a continuation fund by Rittenhouse of a single asset?
It's similar, except in a continuation fund, the fund typically owns the shares to begin with, but this was created directly from the company. So it's similar in concept, but not exactly. I think what's nice about this when you think about it in comparison to other your typical continuation funds tend to have junior securities, and this is a
Yeah.
very senior security. So I think that's one of the advantages that we see here. Any other questions?
No, go ahead. Thank you.
The last company I'll highlight, and this is a little bit different. This fund's invested in a fund called Autotech Ventures, which is a mobility-focused venture fund based in San Francisco in the Bay Area. At their annual forum earlier this year, I met a company there called Hayden AI. What Hayden does is they put cameras onto city vehicles, mainly buses at this time. And from those buses, they kind of draw a map of the city. The initial use of the technology in New York, which is their biggest customer, and you might have read about this in the paper sometimes, is they are capturing people who are driving in bus lanes, and the city can essentially ticket you if you are driving in a bus lane. So be careful when you're driving in a bus lane, because they're going to start ticketing you. The goal is really for the city is not really to generate revenue, although it likely will. It's really to get people from stop driving in the bus lanes, right? Because it impedes the progress of buses. Autotech was able to get us a small part of this Hayden round, which is led by TPG, which you might know. It's at a valuation that is substantially below where other AI companies have been trading. So, I'm sure you've seen OpenAI and others are trading at some crazy valuations. This company, despite having some real technology and real progress, real applications, we got in at a kind of a very low valuation. So it's a company that should be profitable next year. And they've got some really key reference customers. MTA is the biggest transportation system in the U.S., one of the biggest in the world, but in the U.S. And so it's a great reference customer. So we have a small investment through Autotech in this company. It's similar to how we were just speaking. It's a Autotech vehicle in which we are invested. The hope is that we will continue to be able to increase our position through secondary sales in the company. And by doing this transaction, we'll kind of get more in the flow of it. This is a company that I think we're pretty bullish on the prospects, and I think you'll start hearing about it more in New York. And then just to look at the overall portfolio. So this is the 331 portfolio before the investments that we just touched on. And what we've done here is mark to market the portfolio as of today, basically. And so what you'll see is the biggest investment continues to be Daily Pay. So it's a company that we're very bullish on, and that's about 20% of the portfolio. Similar size is Rittenhouse Piano, as we described, and then Enzymatica is just below that. So overall, I would say that the companies are in good shape. The investments are in good shape. None that are really cause for concern at this point. It's early, so I never want to count my chickens. I'll highlight two areas of overperformance right now. Sambazon, which is the leading maker of acai. They sell it on a wholesale basis as well as direct to consumer, has really outperformed. And we just had a call with our board representative for that company. So that company is well ahead of where we thought it would be. So that's a great thing. And Pantera, which was the first investment we made in the company, it's a cybersecurity company, is also ahead of plan. So, we're bullish on that company as well. So far we've completed 12 investments in the fund. We've called about 30% of capital. Typical VCFA fund's going to have 25 to 30 investments. So we're about a third of the way through the fund. These are some of the top holdings, touched on the top 4 already. Freedom Pay is another one that's kind of interesting in the payment processing space. They've continued to do well. Going to speak with the general partner next week to really get a more fulsome update. But I think we continue to believe that's a company with a great amount of promise. So we've got a very active pipeline. We haven't put names down to any of these investments yet because they are not at the stage where they're going to be closing. But I think what we're seeing is over the last couple of years, there's been very limited liquidity in the market. And so because of that, we're continuing to see a lot of opportunities to buy high quality assets at discounted prices. So, I think what you're going to see is by the end of the year, there's going to be some folks who really just need to sell before the end of the year for tax purposes or just to clean up their books. So I would expect us to close another 2 or 3 more deals, maybe a bit more before the end of the year. The restructuring the tech fund, the first one, I think is very promising. We've known the GP for over 15 years. It's actually one of the first deals that I did with VCFA. And they've got a company in their portfolio. It's kind of a hidden gem. It's in the drug development space. They don't develop drugs, but they have equipment that helps in that process. And so we potentially are going to do a continuation fund for that fund at probably about 30%, about a 70% discount to the most recent round. So we're working on that. I don't want to promise anything because nothing's done till it's done. But I think it looks very promising.
Hi, David. Could you please back to that page?
Sure.
Could you please explain more about the continuous diligence or early diligence or what other status of your diligence process and the reason behind them?
Yeah. So when you think about our investment process, what we tend to do is we get a lot of information in, and then we put it into our VCFA form. So we have a model that we've built out over the years that really tries to capture all of the information we have about a fund, and each of the underlying portfolio companies. We try to we have a tab in an Excel model, and each of the underlying portfolio companies has a tab, and we capture all that information. So when we talk about early diligence, we're at that phase usually when we've gathered the preliminary amount of information in that for each of those companies. So for example, when you look at I should have numbered these transactions, but let's say for example the one that says restructuring of a tech fund, $30 million. We've built out the model there, have not met with any underlying portfolio companies, but we've got a good amount of information. If you contrast that with what we've described as continuing diligence, like the first one there, we built out that model, but then we've also had a number of conversations with the general partner. We've had a number of conversations with the CEO of the company, and probably for that company, more importantly, the chief. I think his official title is the chief scientific officer, but really the head technical guy. And then we've also done calls with industry experts as well, right? So early diligence is we're got the initial model going. Continuing diligence is we've really gotten a lot more information to help support and build our investment case.
So what's the next status?
I'm sorry?
what's the next status of continuing due diligence? After that, you have to just invest in that company or that fund.
Usually then we would put something into what we call closing process. So we would have final diligence and then closing process. And sometimes the closing process is very simple. So if we're buying a limited partnership position, that closing process might just be might be able to be completed very quickly. Other times there's a lot of legal work, so that closing process can take a couple of months. So like in the NGen transaction I outlined, we were in that closing process for like 2 months.
David, if we go into your data room, are we going to be able to see some of those underlying documentation that you have for each of those potential transactions?
We usually don't put potential transactions in the data room just because of confidentiality reasons. But I could probably share some information over Zoom with you if you want to like see a little bit more about what we're working on. We should also, I was just thinking like we've moved offices. We're at 56th and Park. We should definitely have lunch sometime too. I think.
Yeah, sounds good. And all the investment that you already done, we should be able to find it in your data room, right?
Yeah, there's information in the data room about all the investments. Yeah.
So, yeah.
And if there's any additional information that's not there or that you want some more detail on, just let me know. And, we're happy to go into more detail. Happy also to put you in touch with some of our analyst associates who can help also fill in some of the gaps that you might be looking for.
And Dave, can you go back to slide number 9?
Yeah.
So this is kind of your existing investment, right?
Yes.
And where do I see that the potential when you're going to be exiting from each of those deals? How much longer do we look? How much longer is the investment period?
So the investment period is 5 years, but I would expect us to be done probably in 4 years or so. So typically we start generating significant returns to liquidity back to investors, usually in about year 3. So we're now in year 2. So I would expect, knock on wood, hopefully to start making some distributions, significant distributions in 2025 and then towards 2026. So we generally model things to 3-year or less hold period. Okay. So I think that's kind of the case with most of the investments here. I would say the kind of the nearest term exit, it's hard to say, but I think we'll have some liquidity probably within Autotech, Arrive, Felicitas, Globespan within those portfolios, probably later this year, but more into 2025. So if you think about our funds historically, we've tended to have distributions before you make your final capital calls, right? So historically, you've only had about 50% of your commitment out of pocket. You start paying for your capital calls with distributions. So that's our plan. We obviously don't control the distributions, and hard to say how things will evolve, but that's how things have gone in the past.
If you go back to the column, say type, right? Restructure versus LP interest. LP interest is basically you buy into an existing LP interest.
Yeah.
Restructuring is you're participating as part of the investor in the restructuring process, right?
Yes.
Okay. And most of those you're looking at a exit starting in year 3, but not more than year 5, right? So the horizon in terms of the cycle of investing and exiting is about 5 years, no more than 5 years, right? Around that.
Yeah, I think that's the plan. With the caveat that you don't know how things will go. So I mean, for example, with piano, they had an offer earlier this year, and so it's possible that they could be sold sooner than we had modeled. It's possible they could be sold pretty quickly if someone really wants the asset. It's a very strategic asset. So we make we make projections about when companies will be sold. Sometimes it's earlier than we have projected. Sometimes it's later. It can be hard to predict.
Okay.
Any other questions?
Yeah, just three quick questions. So I remember correctly, correct me if I'm wrong, but like at the first time, the final close was scheduled in March this year, and later on you guys postponed the final closing to September, since like the target AUM is now reached to your goal. And you just mentioned about like right now the commitment you receive is about 100, and you want to push it to 130, and then final close. So is this a September final close still on the plan, or you have to?
Yeah, September 30th is the final close. No more extensions. That's it. So yeah, we're
Okay.
pushing towards that. Yep.
Yeah, I just want to make sure of that. And also, can you back to the page you will present Hayden AI?
Sure.
Yeah, I notice here it says discount to AI companies. What does it mean?
Yeah, so usually I have like a really analytic discount. So you'll see 46% or 33%. The AI valuations are really all over the place, but they've generally been about they can range anywhere from 10 times revenue to like 100 times revenue. And our and our investment basis here is much lower than that. So yeah, so what I'm trying to communicate, and again, this is a draft, so hopefully maybe I'll come up with a better way to say this, is that we're not at 100 times revenue, right? We're at I believe this is like at 3 times revenue or something along those lines. So it's a much more normal valuation compared to some of the AI stuff that you might see.
Just the uncertainty of the benchmark, not your own purchase price. So that's why you couldn't calculate an exact number of the discount.
Yeah.
Oh, yeah, and my third question is, I have noticed that our last year, 2023 Q4 statement number has been changed like 3 times already. Like one since maybe this March, and after some communication with you, like you guys gave us a update version of the draft. About like in June, we received the final version of the year-end capital statement, and like the numbers is changing. Like I just curious about like how does the valuation determine for us as an investor, like because I know like for those private equities, normally they don't do like quarterly fair market value as you showed on your balance sheet. So are you waiting for the like if there's a like maybe newest series raised for one of the portfolio company, maybe there's a new valuation updated, but like for the others, are you remain the last round valuation, or how does that?
So yeah, so the Q4, the year end valuations are always the slowest for us because there are the audited numbers, and so we have to go through the whole audit process, and so we are we're always delayed in getting out Q4. This year actually has been faster than other years, and one of the things that I'm trying to do is to really accelerate as much as we can getting the Q4 reports out. With that being said, what the auditors like to do is to rely on the audited reports of the underlying investments that we're invested in. So most of the investments that we make are through managers, and the managers are auditing those entities. And so our auditors rely on the fact that the underlying assets are audited, and so we're kind of beholden to them in order to, from a timing perspective. What we try to do is to get out estimates that we think are reasonably close. And so I hope that our estimates were kind of like within the range of what we had told you, because it takes a while. So what we try to do is give you kind of a sense of where we think the valuations are. It's not going to be right, but hopefully it'll be reasonably close. So that's really the what causes our Q4 numbers to be a little bit delayed, and then the assets that aren't audited, we use a third-party valuation specialist. Right now, we're using Carta. So what we try to do is to take it out of our hands, to have more of a unbiased view into valuation. And so for our private companies, we do a third-party valuation. So if you look at the investments here, the direct companies, Sambozan and DailyPay, those valuations were both based on a third-party valuation. And most of the others, I think all of the others, are based on the underlying valuations we received from a fund manager.
David, at the end of this fourth quarter, after you finish your calculation of the fair market value, it may make sense for us to just sit down with you, understanding each of those valuation, particularly in terms of source and what are the basis for those kind of for arriving at the fair market value. So
happy to do so. Yeah, definitely.
So, and Frank, just make sure we set that up, please.
Sure.
Yeah, and we normally we will ask like some the market updates on secondary market, and there are some opportunities you see or some risks or challenges you are facing, and your solution to or your insights, your solution, your plan to do your job. Yeah, we would love to know that.
Yeah, so we're seeing, I'll just put on this slide because I think what we're seeing is that there's really still a lack of liquidity in the market. So we're still seeing a lot of opportunity on the secondary side. The other thing, I think the other dynamic that we're seeing is a lot of the secondary transactions are larger deals, trading at very small discounts. And so when you look at smaller, more complex deals, there aren't many people who are doing those types of deals. So we think that we're in a good position from there. We're also at a part in the cycle which I like, is that a lot of if you think back last year, a lot of what we were doing was marking portfolios to market, right? So we get a valuation from the fund manager, and Clarence, as kind of you alluded to, we have to underwrite that. We have to say, is their valuation make any sense, right?
Yeah.
And a lot of times we look at their valuation, we say, gee, you're saying your company was worth this, but your public comps have gone down by 50%, right? So now, just to pay mark to market, I got to mark you down 50%. And then when we pay a discount, right? So then I got to mark you down another 30%. It's hard to do deals like that, right? Now we're seeing a lot of portfolios where actually the underlying portfolio companies, we believe, have appreciated, right? So, for example, we're having a call with the general partner of a fund tomorrow, a San Francisco-based not biotech, but healthcare fund. And their biggest asset is a public company. Well, from their last report to today, that public company is up 70%, right? Doesn't mean that we can sell it at 70% because they own 40% of the company. It's not practical for them to sell that, tomorrow. but it's better than it being down 70%, right? And so we're seeing a lot of those dynamics where if we buy an asset today at a discount, because the assets might have appreciated, it's actually even a bigger discount, right? So we think where we are in the market cycle is really it's really a good place to be right now.
David, what would be the impact on your valuation in view of the potential interest rate adjustment?
It's interesting. I think if I would say anything, the potential interest rate reduction, which sounds like it's, more than a potential at this point, right? It's going to happen.
Exactly.
It's not going to necessarily impact a lot of what we're expecting from a dollar perspective, but I think what we're seeing is companies are still a little tight in terms of making acquisitions. And I think with the interest rates, I think we'll potentially see more M&A activity in our sector, in our segments. Most of our exits are driven by M&A. And, as companies are a little bit more free with capital, maybe they can borrow some more capital to do acquisitions. I think it might bring in our exit timeframes in certain cases.
Yeah, I think that would be my sense of it. I think what about in the past? What was in the past when the interest rate go down? My guess is the selling price of any company might go up, right?
It can. So it tends to be more correlated with how the public markets are trading than how interest rates are trading, than our interest rates are impacted. So I think to the extent that interest rates impact the public markets, I think that impacts, what we do. I think the public markets have priced in some discount, some rate cuts already. So I'm not sure how that's going to evolve, but I think it tends to be more of a second order effect for us.
Okay.
With the caveat that it's not in this fund, but in our prior fund, we have two companies that are in a sale process right now, and the likely buyers for those companies are probably going to be mid-market to lower mid-market buyout funds. And to the extent that their cost of capital goes down as interest rates goes down, that potentially increases the sale price for those assets. So one of the things, if you step back for a while, I've been doing this for 18 years. Historically, when I started, almost all the exits were to strategic investors.
Yeah.
Now we see strategic investors are still the biggest buyers, but we're also seeing buyout funds, buyout-backed companies buy some of our companies, because as they get more mature, they're cash flowing entities.
Yeah.
They're rolling up entities. So interest rates probably affect our market more than they did in past years. But they've been very low for a long time, so it's really hard to say. Every crisis is different, right?
Yeah, but in general, I mean, the interest rate does have this. I mean, when you have a reduction on that, you would think that the value of the company will go up a little bit more.
It should. It should, for sure.
Yeah, and also, David, I think like over the past few years, you were in this mid-market, a lower to mid-market segment. And then over the past few years, there are more mid-market buyout funds. And those will be your potential exit buyers.
Potentially, yeah. We're seeing increasingly that they are potential buyers of our portfolio companies.
Yeah, Dave, from your past experience, what's how accurate between the final, like the last quarter third party valuation versus the final purchase price where M&A?
They've been very good so far. I've been very surprised that they've done a really good job at projecting exits. With that said, like it's at that point in time, right? So like I think to our company, or one of our portfolio companies that sold this year, a company called Resident Home, that was in Fund 6, not in Fund 7. The valuation was almost exactly how the company was sold. Sold for about $1 billion to Ashley Furniture. They were doing about $1 billion worth of mattress sales. So the valuation there was, kind of spot on. But so the reason I say that is because the company had outperformed, the substantially outperformed in the prior year, right? So it was a big step up from the prior year's valuation, right? So the valuations tend to be really accurate, like if a company is sold tomorrow, but if the company is going to be sold in, 2 years, less so, right?
Yep.
Yeah, we had one of the investments in Fund 6 is a company called Vast Data. They make very high speed data storage for use in AI. And our valuation, we wrote that company down last year in 2022. And then when we redid the valuation, it was about 3 times our cost, because Fidelity invested about, they invested $100 million at about 3 times our cost. So, the further out you go, the less accurate it becomes. And then also if it's a company that's moving very quickly, those are harder to value, right?
Yeah, but I just want to, like, would you say in general speaking, like less accurate is good? I mean, like it's all, like in general speaking, it's all portfolio companies underperform the valuation or overperform the overall valuation in terms of the final purchase price.
We tended to sell companies above the current valuation historically, if you look at it. So that tends to be the case. Not always, but in the majority of cases, the exits have been above the carrying value.
Okay, thank you.
Okay. That's good.
I have one more question, if we can
Sure.
quickly. So we talk about valuation. On the flip side, when you buy the company, I noticed you said Piano, you purchased it at a substantial discount, and there is a pipeline company you're tending to buy at 70% discount. So how would you convince those companies to accept those discounts?
Well, in Piano's case, they didn't at first. They said, we are, we can't do it at that price. And so we're patient, right? We said, we give people a rationale. This is why we think this is a fair price. You need someone to act quickly. Here are the risks to the transaction. So what we try to do is to really be transparent and to lay out both the risks and the rewards of any particular transaction. The other thing I'll say is that liquidity right now tends to be at a premium, right? And so what we'll often say to someone is, look, if you think you can get a better offer, go ahead, and we'll close, right? That's our big selling point, is that, we're people of integrity. If we say we're going to do something, we're going to do it. If we say we're going to close it, we're going to close the deal. And a lot of people will just kind of throw out things. So what we really emphasize is that this is not some, random price that we're throwing out there. We've done work, we've done analysis. Here's what we think. And, if you can convince us that we should be paying more, you're welcome to give us, your side of the story. But we have a rationale for the way we're working.
So does it mean that the seller must have lose some money because of the transaction price?
It depends, right? Like if you think about relative to where they are right now, then yeah, they've lost some money. But I'm working on a deal. I'm going to put out an offer after we get off the call here at a 50% discount to the fair value for a fund, but the fund has gone up in value. So even at our price, they'll still be doubling their money. So, they may still do well, even though they've, that we might not give them a great price. The other thing is a lot of times when we're buying from someone, it's kind of at the end of their fund's life, right? So they've either made their return or they haven't. It's not going to impact a lot of their overall return. So if you think about the NGen deal that we did, it's the last asset in the fund. Whether we give them, 100 cents on the dollar or 60 cents on the dollar, not really going to impact their overall performance. They've done how they're going to do. So, part of it is convincing sellers that you should just get the deal done and not be overly focused on the dollars that you receive. Not always an easy conversation, right? Like, and it requires patience. So, but we're patient,
How niche is the market you just mentioned about, like for that specific scale of the company, try to sell like that portion or that amount of shares, like how many like potential buyers out there try to competing with you?
It's very small. That's why I don't worry about telling people to go find a better price, because there are very few people who will do these types of transactions. So what you'll find is, right now we're working on a deal with a seller, very interesting marketing technology company, and he's got offers for his shares that are at a higher price than ours, but they're not really credible buyers. Right? They don't really have funds like we have. Funds we can close in a very short period of time, and so there really aren't many people out there like us. The closest comps you'll find are there's a firm out there called Willow Ridge Partners. There's a firm called Klein Hill Partners, and they both do smaller secondaries, but they are fairly large funds at this stage. Willow Ridge just closed, I think, an $800 million fund, and Klein Hill is trying to close a $1 billion plus fund. So they tend to do, they actually tend to rely on us sometimes. So they've co-invested in a number of our deals, including the Daily Pay transaction. So it's a very, very limited market.
Okay.
Dave, if we're looking for, I think it's probably important for us to understand how you made the valuation of the investment that you're about to make to the exit value. So is there any way that we can look at some of your investment that you already exit from and take a look at your initial assessment of the value at the time of purchase and compare that to the exit value? Would that be something that tell us something about your decision-making process and how good is your prediction about the potential value?
Yeah, I have. So what I've got is I have kind of a case study on the biggest deal
Okay.
in our last fund, when we bought the venture assets of a large hedge fund. It's not fully exited, but the three largest exits are completed in that. And I can share that with you. I just have to make sure that it's anonymized enough from the seller's perspective. I don't have like a macro view of all the companies that we've invested in, like where we are projected, what we projected in and where they were eventually sold. It's something I'd like to have. Maybe once we get through this fundraise and if we have some more analytic horsepower, we can devote some energy to that. But I don't have that kind of analysis right now. So I mean, the best I could do is kind of give you that case study, if that would be helpful.
I think that would be good because I think it will help us fully understand how you approach your investment, right? Because I think the value, I mean, I think our fiduciary duty is to make sure that we understand how you make a decision.
Mhm.
And then in particular when you make the decision and when the actual outcome come out, what's the difference in there, right? So I think that's so I think if you can at least send us that particular case,
Yeah.
that it will make sure that we fully understand your approach and how you make that acquisitions decision. So that will help us.
Yeah, absolutely. Yeah. It may take, I don't think I'll be able to get it to you probably till next week or so.
No, it's
Yeah.
okay. Okay. Well, I think the key thing is by the time the fourth quarter number is out, that's where we should really take a look at how at the end of the first quarter, third quarter, how you arrive at whatever the valuation is and what's the underlying data that you use, maybe the audited financial statement of each of those investment by the GP or something. So, but I think at the end of fourth quarter, we like to have a full walkthrough of that process in determining the year-ending fair value. So that will be good.
Absolutely. Yeah.
So
Happy to do so.
great. Thank you, David.
Great.
So let's have lunch. There's a lot of good restaurant around us now. The Nordstrom have two good restaurants in there. One is at this stage great. They have a balcony sitting that is great to eat and drink at a time.
I didn't know that. Never been there.
Yeah. So whenever you go, we're usually in the office. I'm usually in the office about Tuesday through Thursday. So if you
Okay.
have any day that you're free up, just give us a call. Come over and we can have lunch together.
Well, let me send you some dates and
Okay,
we'll
sounds
see if
good.
anything works for you.
Yeah.
Great.
Okay. Good, Dave.
Thanks,
so
Dave.
much. Bye-bye.
Bye.
Good luck on final closing.
Thank you so much.
Bye.